Yes. So, good morning, all of you. You all would have done at least one time revision. Not all the topics, maybe majority areas you would have covered. Ale, you would have covered the majority areas at least one time and would have, yes, and highlighted the important topics, highlighted the important questions, highlighted the important topics. That all you would have done. Now, today is April 10th. April 10th, and our exam is in, I mean, May 2nd is our exam. So, what I want to tell you is whether you are doing first group or whether you are doing both groups. Okay, from I'm not saying from today, because today I hope you're all attending that marathon, maybe other subjects also. From tomorrow, for next 6 days, tomorrow, next 6 days, 2 hours, because as we always say, we are following that penetration strategy. Might be you will be in touch with FR, but still a penetration strategy, that is tomorrow onwards 2 hours, definite 2 hours we are spending on small standards. Ma'am, will this be on YouTube? I think I can upload it. So 2 hours, April 11th. Yeah, April 11th. Tomorrow onwards, 2 hours you spend on small Indias. 2 hours you have already done small Indias. Just go through the important question. Good morning. Yes. So 2 hours, 2 hours for the next 6 days. You focus on small Indias. Small Indias. You please focus small Indias for next 6 days. 2 hours. Then from April 17th onwards, 3 hours. Why only 2 hours and 3 hours? Because you have other subjects to do, right? You have other subjects to do. So just 3 hours a day from April 17th onwards for 6 days, 2 hours each. Then this I'll share in that mentoring group. This sheet and the questions which I'm discussing today, I'll share in the mentoring group. Then 3 hours each. So financial instruments, 2 days, 3 hours each. So we are slowly penetrating. After 6 days, we are fixing our time as 3 hours. Financial instruments for 2 days. You would have highlighted the important questions, important areas. RTP question, please give importance to RTP. Two RTP questions are very important that you should do. Business combination also 2 days, 3 hours each. Consolidation 115, 116. So that is the next 8 days plan. First 6 days, next 8 days, and last 6 days I'm fully allocating. In between there is a free day, that is you can choose, you can find out what to be done. And last 6 days, this 5 days in April and 1 day in May, and we are fully doing FR 6 days. We are dedicated to do financial reporting. Okay, so this, if possible, I'm not telling you, you should follow this. You might be following some other plan. Okay, if you have more time and doing only one group, more time, well and good. You can practice more questions. You can invest more time. So that's it. Could be our second revision, and last 5 days could be our, not 5, 6 days, could be our third set of revision or fourth set of revision based on your time availability. Okay, fine. And also quickly, as I, so uh, don't miss out this category one, not this financial instruments, consolidation 115, 116, also this, and very important, analysis of financial statements. In analysis of financial statements, which we are going to do now, I'm not saying anything. See, first 40 to 50 marks definite from this area. Then don't miss out asset standards. Don't miss out asset standards. Sure, 15 to 20 marks question. Maybe MCQs, maybe other areas. Sure, other descriptive questions. Sure, 15 to 20 marks is going to be from asset standards, from any of the standards. And 36 in that asset standards, 36 is very, very important. Then the standards. So this only asset standards I said 15 to 20. Yes, I'll share, definitely I'll share it in the WhatsApp group. Then all together we are expecting a 30 marks from this. And last, because why I'm going fast is you all might be towards now we have only 21, 22 days in front of us, and no need to give the topic wise list, because you already know, you already into FR for so many number of months, so naturally you will be knowing what are the important areas and unimportant. Category 3, I'm not saying unimportant, but still my last weightage topics are the small Indias, professional and ethical duty, and accounting and technology. From where you can get a 5 marks question. Professional ethics, no idea so far. But there are case studies, and this is category 3. Now, so first 15 minutes, I just wanted to share that. Now we'll move on to analysis of financial statements. That is what we promised we'll do at all the case studies and TYK questions in analysis of financial statements. There are 7 case studies and 6 TYK questions, of which I consider very, very important, because these questions, the analysis of financial statements chapter, we can touch only if you have done all the other Indies. All Indies you should have done. All Indies you should have done. Then only we can do this analysis of financial statements chapter. Okay. Now, without wasting time, starting with case study 1. Case study 1. Out of 7 case studies, I'm down with a cough. Case study 1. Case study 1 is actually from our Indes 109. I'm not reading case study 1. It is from our own favorite financial instruments, maybe very first type of questions you have done in class. So analysis, first question is loan given to employees at concessional rates. So this also I will share in the group. Loan given to employees at concessional rate. We are not reading. Indes 109. Financial asset. Indes 109. Financial asset. 109 financial asset. Amortized cost. We have these steps to do. Okay. Step 1 is fair value of cash flows. If I get this question for exam, first I am going to do computation of fair value of financial asset. So present value of cash flows discounted at market rate of interest. Yes, we calculate fair value, and difference will be written off as prepaid employee benefit expense over the contract term. Then we prepare amortization table, journal entries, and we do the balance sheet. Now I want to ask you a question. In the balance sheet, loan given to employees, where will you show loan to employees in the balance sheet? They will ask balance sheet extract. Loan given to employees, where will you show in the asset side? Loan given to employees. Asset side, non-current assets or current assets? That is the question. Will you show it as non-current asset or current asset? Both non-current asset and current asset. Both non-current asset and current asset, because there is repayment every year. There is repayment every year. All this financial liabilities, financial assets, you have to break it as non-current and current. Okay, non-current and current. How much you will show it as non-current asset? Next year's closing balance will be shown as non-current asset. Next year's closing balance. What is that? If I prepare this amortization table, yes, amortization table year 1, interest, repayment, closing balance. You are standing in year 1. So this is the year 1's closing balance. But year 2's closing balance should be shown as non-current. And difference of total closing balance minus what you are showing it as non-current will be presented as current. When you show prepaid expense also, don't forget to break it. What will be written off in the next year is current, and balance will be shown as non-current. Other non-current assets, current assets, you will show the breakup. So I want to discuss only that. Case study number 1. You all would have tried a similar type of question. Definitely you would have tried. But what are the steps? If I get a financial instrument question, I know step 1, step 2, step 3, step 4. If they are asking, I need to show the breakup as non-current and current. That's it. Now, I think I can move on. Case study number 2. Case study number 2. Also, are you reading this case study number 2? I have no plans to read this because this question also, this is something which you all would have tried in class. This is from an independent Ind AS 105. So independent Ind AS 105, 105 you all would have done, and I am right. I've written the content. What is the content here? Ind AS 105, the whole question content is here there is temporary abandonment of asset. In analysis of financial statements, case study number 2. Yes, there is temporary abandonment. Time being the asset is not used. Time being the asset is not used, but the accountant has categorized the asset as held for sale. Is that correct? No, it is not correct. It is not correct. So conditions for categorizing the asset as held for sale failed. So it should not be categorized as held for sale. It is a PPE and not held for sale. So depreciation has been stopped, but you should continue charging depreciation. But because you stopped charging you categorized it as held for sale because of the decline in demand. So you need to check whether there is an indicator for impairment excess. Okay, so it's a basic question which came in exam. So I think you all are okay with this case study number 2. I'm not reading in detail because we have important questions coming up. We have important questions. So these questions, I don't want to waste time on it. Okay, case study number 3. Case study number 3. This is on Ind AS 2 and Ind AS 10. Ind AS 2 and Ind AS 10. What is there in Ind AS 2 and Ind AS 10? On 5th April 2012, a fire damaged a consignment of inventory at one of the Jupiter Limited's warehouse. When did the fire happen? The fire happened on 5th April, which means after the year end, after the reporting year end. This inventory had been manufactured prior to 31st March 12, costing 8 lakhs. Cost of inventory on the reporting date is 8 lakhs. The NRV is 9.6 lakhs. Okay, fine. Because of the damage caused to inventory, an additional amount of 2 lakhs is required for repairing and repackaging of the inventory. The inventory was sold on 15th May for 9 lakhs. So what is this? There was an inventory, cost of inventory is 8 lakhs. And on that date, NRV is 9.6 lakhs. But on 5th April, there was a damaged fire. There is a fire that damaged the inventory. So now, to make the inventory ready for sale, you had spent 2 lakhs extra. You spent 2 lakhs extra and 15th May, you sold it for 9 lakhs. Now the question is, the accountant has treated this as adjusting event and cost 8 lakhs. Accountant measured NRV at 9.6 lakhs minus 2 because there is a 2 lakhs extra he needs to spend, 2 lakhs. So inventory was recorded 7.6 lakhs. Is this correct? So your answer should be, should I wait for your response? No, we'll move on. Answer should be, it is not an adjusting event. Why it is not an adjusting event? Because it clearly happened after 31st March and no conditions were existing on 31st March. So it's not an adjusting event. So inventory should be measured at on 31st March. So the content is on adjusting event and damage should not be considered. Inventory should be measured at 8 lakhs. Inventory should be measured at 8 lakhs. That's it. Okay. Now, this is also easy. Case study number 4. On 1st April 2011, Sun Limited has acquired 100% shares of Earth Limited for 30 lakhs. Sun Limited has three cash generating units, A, B, C, with fair value of 12 lakhs, 8 lakhs and 4 lakhs. So 12 plus 8 plus 4. 24 lakhs is the value of total assets acquired, fair value of total assets acquired, but you paid a PC of 30 lakhs, which has resulted in a goodwill of 6 lakhs, which has resulted in a goodwill of 6 lakhs. Okay. The company recognizes goodwill of 6 lakhs. Yeah, that's correct. During the financial year 12-13, that is next year, second year, the CFO of the company has a view that there is no requirement for any impairment testing for CGU since recoverable value is higher than the carrying value. Hence, they have not tested. According to this CFO's advice, they have not tested impairment. So, what you should do for goodwill, you are supposed to write the provisions of Ind AS 36. Goodwill annual impairment is required. Whether there is indicator or not, for three assets, whether there is indicator or not, you should test for impairment on three assets. What are those three assets? Goodwill, intangible asset with indefinite useful life, intangible asset which is not available for use, Yes. Now this question number 5. Very, very important. They will give a balance sheet with mistakes and you need to correct that. So this is a very good question which can be asked for exam. Deepak Limited started a new company, Soft Bharati Private Limited, with Iktara Limited, where investment of 55% is done by Iktara Limited and rest by Deepak. So Deepak is actually an NCI. 45% share is with Deepak and Iktara is having 55% share. Voting powers are to be given as per proportionate share of capital contribution. Yeah, 45-55 is their voting power. The new company formed was the subsidiary of Iktara with 2 directors and Deepak eventually becomes one of the directors of the company. A consultant was hired and he charged 30,000 for incorporation expense of the company and to do other necessary statutory registrations, and 30,000 is to be charged as expense in the books after incorporation of the company. What is the treatment of this expense? Preliminary expense, pre-incorporation expense. What should be the treatment as per Schedule 3 Ind AS? Should be immediately charged to statement of P&L. The company Soft Bharati was incorporated on 1st April 1 date. Financials of Iktara is prepared as per Ind AS. See, financials of Iktara is to be prepared as per Ind AS means if one company prepares in the group prepares financial statements as per Ind AS, automatically its subsidiary, holding, associate, joint venture should prepare financial statements as per Ind AS. Soft Bharati Limited has just born, but it should prepare financials as per Ind AS because its holding company is following Ind AS. An accountant who was hired at the time of company's incorporation has prepared the draft financials of Soft Bharati Private Limited for the year ending 31st March 2012 as follows. What's this? Revenue from operations, other income, expense, decrease or increase in stock in trade, employee benefit, depreciation, other expense, current tax, deferred tax. Okay, fine. And a balance sheet is also given, share capital. So just see the format. Is this format correct? No, the format is not correct. First they have done equity and liabilities, then assets. Okay. Now, what are the adjustments? Deferred tax liability of 6,000 is created due to the following temporary differences. Difference in depreciation as per income tax and accounting profit. PPE as per books is 1 lakh and PPE as per income tax is 80,000. So naturally carrying value of asset is more than the tax base, therefore on 20,000. So tax rate must be 30%. That is how they have created a deferred tax liability of 6,000. Now, pre-incorporation expense. All of you listen and involve, participate. Okay. Pre-incorporation expense are deductible on straight line basis over 5 years as per income tax. However, the same are immediately expensed off in the books. There was a 30,000 pre-incorporation expense. Of that 30,000, it is fully written off in P&L as per books. So carrying value is 0. But this 30,000 is allowed on straight line basis for 5 years. So which means 30,000 divided by 5, 60,000 is allowed as expense. 60,000 is claimed as expense as per tax records. So in the tax, there is a carrying value of 24,000. 0 carrying value as per books, 24,000 as per tax records. What do you need to create? DTA. DTA, carrying value as per tax records. Or I'm just applying my mind. More deduction in future. So we need to create. Here the content is, so which is not done. They have only created a DTL. We need to create a DTA. Okay. Then current tax is calculated at 30% of PBT. 3,55,000 without doing any adjustments related to income tax. Oh, the correct current tax after doing adjustments is 1,25,700. So what is this? How much is provision for tax appearing? 3,55,000 into 30%. But correct amount is 1,25,700. So this 19,200 should be adjusted. 19,200 should come as current tax, but they have not, they have just applied 3,55,000 into 1,06,500. So you need to do the correction, yes or no? With the corresponding effect to P&L. Deferred tax asset to be created with corresponding effect to P&L. Yeah, correct. Now, after the reporting period, the directors have recommended a dividend of 15,000. After the reporting period, the directors have recommended a dividend of 15,000 for the year ending 31st March 2012, which has been deducted from reserves and surplus. Dividend payable of 15,000 has been grouped under other current liabilities along with other financial liabilities. Guys, is that correct? It cannot be done. It cannot be done. It cannot be done. Therefore, what you should do? Reverse. Because as per Ind AS 10, if dividend is declared after reporting period, it is a non-adjusting event. So remove from liability and add back to reserves. Okay. Are you all okay? Is that clear up to this? So it's like we have some adjustments. We need to correct it and prepare a full set Ind AS balance sheet. That's it. There are government statutory dues amounting to 15,000 which are grouped under other current liabilities. Okay. Government statutory dues grouped under other current liabilities. The capital advances, other current liabilities. Okay. 45,000 is there in other current liabilities. So it is like from 45,000 dividend declared I need to eliminate. Okay. Now capital advances of 15,000 are grouped under other non-current assets. Other non-current assets 50,000. Okay, fine. Other current assets 51,000 comprise interest receivable from trade receivables. Fine. Current investments of 30,000 is in shares of the company which was done with the purpose of trading. That is current investments. So it must be FVTPL. Current investments has been carried at cost. Fair value is 50,000. So if current investments held for trading, it should be categorized as FVTPL. But they have recorded at cost. So we need to record it at 50,000. So there will be a gain of 20,000 which is to be reported in P&L. Okay. Actuarial gain on employee benefit measurement 1000 has been omitted in the financials of Soft Bharati Private Limited. So actuarial gain should be reported in, actuarial gain should be taken to, a gain missed out, a loss missed out. All this is having deferred tax impact also. We'll be having a deferred tax impact. Okay, fine. So, yes, actuarial gain will be reported in OCI, right? Actuarial gain or actuarial loss will be reported in other comprehensive income. Other comprehensive income, and it will be having a deferred tax impact. That deferred tax impact also will be taken to other comprehensive income. Okay. So you're required to ascertain whether the financial statements of Soft Bharati Private Limited are correctly presented. If not, prepare financial statements of Soft Bharati after the careful analysis of mentioned facts and information. Okay. So here, what are you supposed to do? Here in this whole question, what am I supposed to do is regrouping of, if it is a financial asset, financial liability, you need to regroup that financial asset and financial liability. Deferred tax liability, you need to recompute. Reverse dividend declared and prepare correct statement of P&L and balance sheet. Listen. Nothing to adjust in our sales. No adjustment was with regard to sales. Sales related nothing. So no adjustment. Okay. Other income. Can you trace out what is that 20,000? Gain on revaluation of investment. There is an investment, cost was 30,000. They were recording it at cost, but fair value is 50,000. So if it is FVTPL, 20,000 should be increased. Are you clear? Yes. So first 20,000, there is a gain. I adjusted. So correspondingly, investment should increase. Purchase. Stock in trade related, nothing was there. Stock in trade related, nothing. So no adjustment. Here also nothing, no adjustment. No employee benefit expense adjustment. Nothing related to depreciation. Other expense, total expense, PBT. This is the corrected PBT. In that there is a 20,000 gain. Okay. So, and this is the corrected, this was given. See, this was given. 125,700 was given in the question. This is the correct tax. Okay. Deferred tax. Now how do we calculate this deferred tax? See, I'm not checking what is given. See, there is a 1. Carrying value versus tax base. Carrying value versus tax base, or time save and what is better is just going through this. Okay, so listen what is to be done. Here PPE already they have created detail. Now there is a pre-incorporation expense. Pre-incorporation expense, carrying amount is nil, tax base, this we have already said, there is a DTA on 24,000 into 30% DTA. Now there is a current investment. Carrying amount now has become 50,000 and tax base is 30,000 because tax base cost is 30. So on this also there is a DTL. Carrying amount of asset is more. Carrying amount of asset is more. Therefore, you need to create DTL. So 12,000 minus 7,200. How much is the net DTL to be created? 4,800 should be the DTL in P&L. Now there is a actuarial, some long-term provision for employees. They have given there is a difference of 1,000 gain. So 300 DTL to be created in OCI. If the gain is in OCI, DTL also should be recognized in OCI. Are you understanding? That is how this 4,800 came. This 4,800, yeah, 4,800. So profit for the year is 2,44,500. I am sure you will be able to do. If you get a question like this, you will be able to do this. Okay, there are few adjustments, but it's all comfortable. Now OCI, other comprehensive income. OCI, we need to show like A, items that will not be reclassified to P&L, B, items that will be reclassified to P&L. Here there is only one item. Ind AS 19, items that will not be reclassified to P&L, because Ind AS 19 remeasurement gain or loss, actuarial gain or loss, asset ceiling gain or loss, that is transferred to OCI, will be reclassified to retained earnings. Do you remember that? So that will not be reclassified to P&L. So there is 1,000 actuarial gain in OCI and a corresponding DTL tax 300. So net 700. So total income in the balance sheet will be profits 244,500 plus 700 245 200. Are you okay? So they may ask only this part, statement of P&L part only they may ask. Is it clear? All of you? Yes. And you will do it. You will do it. You will be able to do this. Then balance sheet. What are the corrections in balance sheet? Corrections in balance sheet. See, it's more like regrouping of items. What regrouping of items? So first, let me go through the asset side. PPE, 1 lakh. No, this is question. This is actually the question, not the answer. This is the question. So how these figures are coming in the answer is what we are going to check. So PPE 1 lakh. Okay. Long-term loans and advances 40,000. Long-term loans and advances 40,000. Is there anything given regarding long-term loans and advances? Long-term loans and advances related, nothing is given. Other non-current assets is capital advance given. Capital advance. Okay, capital advance given to suppliers for distribution of, for the supply of fixed assets. Current investments will change to 50,000. Inventories, no adjustment. Trade receivables related, no adjustment. Cash and bank balances related, no adjustments. Other current assets, 51,000. Interest receivable from trade receivables. 51,000 comprise interest receivable from trade receivables. This 51,000. Now, when you prepare the balance sheet, PPE, first I'll write no change. Long-term loans and advances, before that we should give the prefix financial asset. Before long-term loans and advances, we should give the prefix financial asset. Okay. Then capital advances, we should not give the prefix financial asset. Current investments, before that you should give the prefix financial asset. Trade receivables, give the prefix financial asset. Cash and bank balances, other current assets also you should give the prefix financial asset. Why? Other current assets, because interest receivable from trade receivables. Trade receivable is a financial asset. Interest receivable from trade receivable is also a financial asset. So here on the asset side, just have a look on the note, just go through PPE, okay. Financial assets, long-term loans and advances. Other non-current assets, 50,000. Refer note 2. What is note 2? This is not a financial asset. Capital advances given for fixed assets is not a financial asset. Okay, fine. Inventories, no adjustment. Then we are giving the heading financial assets, investments, 20,000 increase. Trade receivables, no change. Cash and cash equivalents, no change. Interest from trade receivables, no change. Now my balance sheet total 5,41,000. Okay. Now liability side of the balance sheet. Liability. Share capital, no change. Reserves and surplus, there is change. I need to show reserves and surplus, there are changes. PBT, profit after tax, has changed. We need to show OCI, reversal of dividend. So that adjustments are there. So reserves and surplus will change. And instead of reserves and surplus, we should give the name when you prepare the proper other equity. Non-current liabilities, long-term provisions. Is there a change in long-term provisions? Can anyone say the amount in long-term provision? There is an actuarial gain to be reported, right? Actuarial gain. So this liability will reduce by 1,000. Yes or no? There is an actuarial gain, so the liability should reduce by 1,000. Deferred tax liability will change. Trade payables will not change. Other current liabilities, there is a change. Dividend reversal. Short-term provisions, no information is given. So what is there in my balance sheet? Liability side. Equity share capital, no change. Other equity, we'll find out what are the changes. Provision, 1,000 reduced. Deferred tax, 4,800 plus 300. P&L and OCI together. Then trade payables, before that we are giving the heading, financial liabilities. Other current liabilities and current tax liability. Provision for tax. Once more, that is, listen, once more, just quickly. This current liabilities, trade payables, we need to give the title financial liability. Okay. Now, other current liabilities, 45,000 is there. Yeah. In this other current liability, 45,000, I don't know what is the nature of this other current liability, but I know 15,000 is dividend declared. Okay. Now a 15,000 is payable to government for statutory dues. Balance 15,000, I don't know what it is. So this is reversed. Now, what is payable to government is not a financial liability. Statutory dues is not a financial liability, because financial liability means contractual liabilities. You don't have a contract with the government. So contractual government dues are not considered as financial liabilities. It is a statutory liability. So separately you should present. Balance 15,000, we assume it as financial liability. Wait. How they have presented? Financial liabilities, trade payables 11, other financial liabilities 15, then other current liabilities government. So total 30,000, 45,000 was there, 15 I reversed, balance 30, of which 15,000 is financial liability and balance 15,000 is other current liabilities, and provision for tax has become 1,25,700. Same from the P&L. This is also given. So only the changes in other equity, 244 500, other equity 245 200, this is taken, 244 500 P&L, 700 OCI, so total. And some notes they have given for your understanding if you read. So, is it okay? But this can be asked for exam. This question is there in your study material for so long and they have not asked this question for exam. Maybe they can ask this exam for 14 marks. This and May 18, May 19, we got similar questions. But in the new syllabus, that is in the news recently from November 19, this type of questions were not asking. When this type of questions are coming, there is no question from consolidation. Small question from consolidation. Small question from business combination, but this will take that long answer question role, 14 marks. Okay, so we are just getting prepared for that. I hope that is clear. Then case study number 6. And is there any doubts to be cleared from this case study number 5? Anything? No, all good. Now listen. This question number, sorry. Question, case study number 6. Mumbai Challengers Limited, a listed entity, is a sports. Ma'am, please explain once after the end defer tax concept alone. Defer tax, explain once after that. After the end means once we are ending the session. I mean, okay, after this question, I'll explain. I'll quickly give the defer tax based on that question or an overall idea about defer tax. Based on that question, Ano, Ado, just overall, a quick overall. Okay. Case study number 6. Mumbai Challengers Limited, a listed entity, is a sports organization owning several cricket and hockey teams. So this also, guys, this is a very good question. Please focus. Mumbai Challengers Limited, a listed entity, is a sports organization owning several cricket and hockey teams. The issues below pertains to the reporting period ending 31st March 2012. Owing to proposed schedules to Indian Hockey League as well as Cricket Premier Tournament, Mumbai Challengers Limited needs a new stadium to host sporting events. Okay, fine. So Mumbai Challengers Limited is a listed entity that they need a new stadium to host the sporting events. This stadium will form part of PPE of the company. Mumbai Challengers Limited began the construction of the stadium on 1st December 2011. The construction of the stadium was completed in 2013. Cost directly related to the construction of the stadium is 140 crores in December 2011. In December alone, they have spent 140 crores for this stadium. Now, thereafter 350 crores. How can they spend 350 crores in a month? Thereafter 350 crores have been incurred per month until the end of the financial year. The company has not taken any specific borrowings to finance the construction of the stadium, although it has incurred finance cost on its regular overdraft, which were avoidable had the stadium not been constructed. Mumbai Challengers Limited has calculated that the weighted average cost of the borrowings from 1st December to 31st March is 15% per annum on annualized basis. Company seeks your advice on the treatment of borrowing cost in its financial statements for the year ending 31st March 2012. So what is this? See, in December, the company has spent 140 crores for the, in December, the company has spent 140 crores, January 350 crores, February 350 crores, and March 350 crores. The company has spent this much amount for their new stadium. Okay. For the new stadium, they have spent this much amount. Okay, that I understood. Now, there is no specific borrowing, but they have a bank overdraft. From that bank overdraft, they are incurring expenditure. If there was no stadium, that interest expense would not be there. And bank OD interest rate is 15%. So can you capitalize, or how much interest can be capitalized? Can you capitalize the interest? Yes, I can capitalize the interest because the need not be here. What they are telling is there is a bank OD, regular bank OD. They otherwise also they have bank OD. So it is general borrowing. And general borrowing in weighted average cost. See, weighted average interest cost is 15% per annum. So how much is the borrowing cost to be capitalized? 140 into 15%. 4 by 12. December, we'll assume it as December 1st. December, January, February, March. 350. 3 by 12. 350 per month. So February, 2 by 12. March, 1 by 12. This is the interest that you can capitalize. Again, I just wanted to share the content and move on. I need to try a very good question from Index 23, practice questions, which was an old RTP question, but I don't want to miss those areas. That is why I'm moving on quickly. Is this okay? Hmm? Yes. See, this question number, case study 6, A part is comfortable for us. It is comfortable. We feel okay, borrowing cost, we are studying borrowing cost from our intermediate level, and this type of question can come in intermediate level also. We'll try, it's fine. But question number B, we don't have that much of comfort while reading this question number B. What is this? Mumbai Challengers acquires and sells player registrations on a regular basis. Player registrations. What is this? For a player to play for its team, Mumbai Challengers must purchase registrations for that player. Of course, you all would be aware of that auctions before IPL. For you are actually purchasing player for each team. Yes or no? By doing auction. Yes. So Mumbai Challengers purchase registrations for that player. These player registrations are contractual obligations between the player and the company. So there is a contract between them. The cost of acquiring player include transfer fees, league levy fees, player agent fees incurred by the club. So here you are buying a player registration. So how this player registration will appear in your books? That is question number 1. That question number 1, how they will account this acquisition. Yes, this should be recorded as an asset. Ind AS 38, very good. Ind AS 38, intangible asset. Because you are acquiring not that player, but player registration for a specific period. Intangible asset. And all this directly attributable expenditures will be capitalized. Fine. At the end of each season, so first season of IPL is over. At the end of each season, which happens to be at the end of the reporting period end, the club reviews its contract with the players and makes decisions as to whether they wish to sell or transfer any player registration. Year end, what they do is they find whether they need to sell or transfer any player registration. The company actively markets this registration by circulating with other clubs a list of player registrations at their estimated selling price. So year end, if they do not wish to continue with some player registrations, they will sell it. So they have actively marketed it and at their estimated selling price. Player registrations are also sold during the season. There will be performance conditions attached. In some cases, it becomes clear that a player will not play for the club again because of, for example, a player sustaining a career-threatening injury. We cannot see, sometimes some players will not play because there will be some career-threatening injuries, leg injuries, back injuries happening. So they cannot play. I bought that player, but they cannot play. So they cannot be sold. They should be removed from the playing squad for any other reason. The playing registrations of certain players were sold. Some players have been sold for 175 crores. Book value is 49. So what is to be done? For this acquisition, for the extension review, for player registrations, what are the accounting treatments to be done? So very easy, guys. What I said is, for once you have seen this, I'm telling you, if a similar question comes, You should have an idea. Okay, I have seen this in analysis of financial statements chapter. So what is to be done? Point number 1. Initially at the time of acquisition, it should be accounted as per Ind AS 38. And that is to be amortized over the remaining expected life. It should be spread over. Then, if you're planning to sell some assets, then it is held for sale, because held for sale conditions are also given. Where so there is no they are not connecting any area to Ind AS. It is your responsibility to identify. When you read a scenario, oh, this can be related to 105. Here there is no issue. I've already written the standards there. So you need not think much. But exam, if you get a situation, you need to relate. Oh my God, which area, which standard this is. So here they are telling this is actively marketed at estimated selling price, and there are it is expected to be sold. So Ind AS 105 provisions you need to write. If it is held for sale, it should be recorded at. If it is held for sale, the player registration should be recorded at. If it is held for sale, player registration should be recorded fair value less cost to sell. Fair value less cost to sell. And if you are not selling, but there can be, as they have given, there can be some player injuries. Player injuries happened, then what is to be done? Then the asset is impaired. Yes or no? You cannot sell it. Asset is impaired. Carrying value is more than its recoverable value. So you need to write the provisions. First one in Ind AS 38, one paragraph you need to write. Asset acquired, intangible asset. What is an intangible asset? They have written long answers. But exam, you check the marks. Accordingly, you need to give the answer. Okay, so here long answers they have given. So in this, ma'am, as it is intangible asset, it is Ind AS 38. Since the contract can be sold, then Ind AS 105. Can you once more let me read that chat? It's gone. Can you explain how Ind AS? Yeah, see, Harsh. See, Harsh, all assets cannot be sold. That is what. I have bought multiple player registrations. They have there can be 14 or 10 player registrations I acquired, of which 6 maybe I can sell. So this I can categorize it as per Ind AS 105. But 4 is not capable of being sold due to some other reasons. That is what they have given, like player injuries. It cannot be recovered. For this 4 I cannot sell. Okay. Now then I have to check for whether there is impairment write-off possible. Is that clear? Yeah. So that is what for if it is 105, then 36 will not come. Either 105 or 36. So that is what the question says. In some cases, see, in some cases, it becomes clear that a player will not play for the club again because of this reason. Some players were sold. So some players are sold. Some player registrations are sold. Some player registrations cannot be sold. In that case, impairment, we need to check whether impairment can be tested or not. Okay. I hope that's okay. Now, C part. What is the C part? C part is again a bit, let's read and find out. Mumbai Challengers Limited measures its stadium in accordance with revaluation model. So they have a stadium. They are measuring as per revaluation model. Okay. An airline company has approached the directors offering 700 crores for the property naming rights of all the stadiums for next 5 years. So one airline company has approached your Mumbai Challengers to get the naming rights, to get the property naming rights. What is this property naming rights? That is, if there are all stadiums are having some names. Yes or no? Jawaharlal Nehru Stadium in Ahmedabad. We have not Ahmedabad, right? Yeah, there is a Narendra Modi Stadium. So this naming rights, some companies will buy that naming rights. They will buy that naming rights, and what they do is, for the airline company, it is an intangible asset. They will buy the naming rights, and if you want to name, then you need to pay them. The naming rights are with that airline company. So that airline company approached your company, it's getting worse, offering 700 crores for the property naming rights of all stadiums for 5 years. Okay, fine. Three directors are on the management board of both Mumbai Challengers and airline. Okay, three directors are common. Three directors are common means Mumbai Challengers, three directors, are airline companies, three directors. Okay. Additionally, statutory regulations, legislations regulate the financing of both cricket and hockey clubs. There are statutory legislations. These regulations prevent contributions to capital from a related party, which increases equity without repayment in return. Failure to adhere to these legislations could lead to imposition of fines and withholding of prize money. Mumbai Challengers wants to know how to take accounting of this naming rights in the valuation of stadium and potential implications of the financial regulations imposed by the legislations. What is this question all about? I didn't understand. What is this? What is to be done? What is the requirement? I'll read this again. So if you get an independent question for 5 marks, Mumbai Challengers wants to know how to take account of this naming rights in the valuation of stadium and potential implications of the financial regulations imposed by this legislations. Now listen, you know, first, ma'am, fair valuation. They are asking about, do you take this property naming rights while valuing the stadium? Will you take, because there is a value for the naming rights which I can sell. Yes or no? Now I am owning that stadium. Stadium means we'll value that land, that what amenities you have, all will be valued. But that is also having a property naming rights which I can sell. Stadium, by retaining the stadium, I can sell that property naming rights to another party. So can you include that property naming rights value also while valuing the stadium? So what should I write? I should write the principles of Ind AS 113. I should write the principles of Ind AS, provisions of Ind AS 113. Ind AS 113, fair value of non-financial asset. This provision I need to write. Fair value of non-financial asset. Do you remember highest and best use? There is something called highest and best use. When you calculate the value of a non-financial asset, you should write highest and best use. All the conditions and restrictions attached with the asset should be considered. Then asset should be physically, that options which you are taking should be physically possible, legally permissible, and financially viable. So that is what I said. You should do that in days 113 and then come to this not then you should write all these points, and hence property naming rights also should be considered while valuing the valuation of stadium. Fair value is the exit price, all the possible benefits, highest and best use from the asset, all the options, all the everything should be considered while valuing the asset. So first you should quote this 113 and write the points. Okay, what is fair value? So institute has written all the provisions of Ind AS 113 for this in the answer. What is fair value? Fair value is the exit price. that asset, the price that the entity will be receiving when an asset is sold. So all the provisions and this highest and best use, all these points they have written, so that should be considered. Now second point, if can you sell this property naming rights to a related party? There are some regulations with regard to related party. So here, how can I say there is a related party transaction here? Because three directors are common. So now I need to remember what is given in Ind AS 24. Ind AS 24, just because if there is a common director, is it a related party? Come on, respond, please. If there are directors, can I say that they are related parties? No. Just because there are common directors, I cannot conclude that there is a related party. Common directors, simply because there are common directors. They are not telling common directors are having control. Common directors having influence. Common directors jointly control. Nothing is given. Just by virtue of having two or three common directors, it cannot be concluded that there is related party transaction or related party relationship. So here we have to write the provisions of Ind AS 24. Here there is no director payments. There is no director payments. There is an offer. They have approached, an airline company has approached us. Okay, an airline company has approached us to sell this naming rights at 700 crores. But the question is, can we do that because there is a related party, there is a statutory legislation, the regulations prevent contributions from related parties. So can you do that? So first you should write there is no related party relationships. If there is related party relationships, it cannot be done. If three directors, just by giving three directors, it cannot be concluded that there is related party relationship. So the transaction can be done. But if it can be proved that there is relationship, then that transaction cannot be done because there are statutory requirements. Did you get that? Do you need to read this once more? Are you? So this question can be asked for 5 marks, but that 5 marks is very, very important for us. Okay. Ma'am, previous question, tell how to write answer for Ind AS. Previous question. See, uh, see if the property, if the player registrations cannot be sold, if player registrations cannot be sold, then it will still appear as intangible asset. But answer is from the study material answers I'll share. Okay. I'll share this page uh, and the study material answers I can share. So here what is given? See, if there is player registrations, one second. In that B part, player registrations are appearing as intangible asset. So 38, intangible asset. As per Ind AS 38, intangible asset is appearing. Now, this year end, reporting period year end. Some player registrations satisfies held for sale condition. So this player registration, this is, if this is my balance sheet, this is my asset side, this is non-current assets. This player registration is appearing as non-current asset, intangible asset initially. Then year end, non-current assets. Some assets will be retained as player registrations as per intangible asset 38, which cannot be sold. Some player registrations, current asset, other current assets, it will remain as player registrations held for sale at fair value less cost to sell. Are you following? So the player registrations which were appearing as non-current asset, but because of some reasons it cannot be sold. So it will naturally impaired. There are indicators for impairment, yes or no? It is impaired. So you can write it off as impairment loss. You have to, it is not held for sale. It is not held for sale, but it is remaining as a non-current asset. But is there a value, recoverable value? Because it's given in the question that there can be some life-threatening injuries. So physical damage. If a PPE is physically damaged, internal indicator. Yes or no? Physical damage is an internal indicator. Can I move on to the next one? Are you clear? Okay. Yes. I know the value of time. I know the value of time, so I don't want to do anything in detail. We are quickly moving on. Yes. Neelanchal Gas Refinery, hereinafter referred to as Neelanchal. Okay, a listed company is involved in the production and trading of natural gas and oil. And these type of questions, without reading in detail, you will not understand. So what is the point in discussing? That is why I am reading in detail. So Neelanchal Gas Refinery Limited, hereinafter referred to as Neelanchal, is a listed company and is involved in the production and trading of natural gas and oil. Okay. Neelanchal jointly owns an underground storage facility with another entity, Seemanchal Refineries Limited. Okay. So Neelanchal jointly owns an underground storage facility with Seemanchal Refineries Limited. Both the companies are engaged in extraction of gas from offshore gas fields which they own and operate independently of each other. Okay. Neelanchal owns 60% of underground facility and Seemanchal owns 40%. So what is given here? What is given is they both own, they are engaged in extraction of gas from offshore gas fields. They operate independently, but underground facility, that is PP, underground facility for the extraction of this oil, that they own together. They jointly own underground facility. Neelanchal owns 60% of underground facility and Seemanchal owns 40%. Both the companies have agreed to share services and cost accordingly, with decisions relating to storage facility requiring unanimous agreement. The underground facility is pressurized so that the gas is pushed out when extracted. When the gas pressure is reduced to a certain level, the remaining gas is irrecoverable and remains in the underground facility until it is decommissioned. As per the laws in force, the storage facility should be decommissioned at the end of its useful life. So they seek your advice on the treatment. What is the treatment? Here, did you understand the question? So there is an underground facility which is owned by both the companies in 60:40 ratio. This underground facility is to be underground facilities is to be decommissioned. How gas? The underground facility is pressurized so that gas is pushed out when extracted. When gas pressure is reduced, then remaining gas is irrecoverable and remains in underground storage facility. It is remained as a part of that. It will remain as irrecoverable gas, means it can be recovered only later on. So this is the process. So how will you account? So here, what are the contents I need to write? Ind AS 111. In this Ind AS 111, can you give what is you should write exam. In exam, if you get this for 5 marks, first you should write what is a joint arrangement. Joint arrangement is a contractual arrangement between two or more parties to carry out an economic activity which is subject to joint control. What is joint control? Unanimous consent is required while taking decision. Unanimous consent is required for taking decisions for relevant activities. Okay. So here, is it JO or JV? Have you done Ind AS 111? Is it JO or JV? It is JO because we have not started a new company, separate legal entity is not formed, and you know the conditions, it's JO. So this Neelanchal and this Seemanchal should take 60% of this facility, 60% total underground facility, 60% and 40% should be separate, it should be divided. I'm really sorry. 60 and 40 should be shared. Now in A16, PP, whatever is the total cost of the PP should be shared in 60:40 ratio. Now why should I write Ind AS 37? Because in Ind 16 and 37 there is a decommissioning liability. PP2 provision for decommissioning liability. We don't know how much is the amount, but that PP to decommissioning liability also should be accounted. PP is distributed in 60:40 ratio. This decommissioning liability also should be shared in 60:40 ratio. But remember what? If a liability, contractual obligation is jointly or severally liable, jointly or if a liability is jointly and severally liable by two or more parties. See, this is as per Ind AS 37. So here Neelanchal, very good. Neelanchal will take over 60% of commission, that decommissioning liability. Neelanchal will take over 60% of decommissioning liability. Yes. And 40% liability is with Seemanchal. But I have to show it as here they are jointly and severally liable. Then in the books of Neelanchal, 60% will appear as provisions, long-term provisions. And balance 40% should be disclosed as 40% should be disclosed as contingent liability. Should be disclosed as contingent liability. Will be disclosed as contingent. Similarly, Seemanchal will be taking over 40% of liability and balance 60% should be disclosed as contingent liability. Did you get that? Are you okay? See why it is disclosed as a contingent liability. The reason is, see, I have contracted or both of us have contracted. Now, whenever we are jointly liable, tomorrow if the other party is not paying it, automatically the liability will comes to you. Because you are joint operators, if other party, in case other party is not settling it, then it becomes your liability. Okay, it's more or like concepts, more or like that of our partnership. If one partner is not doing, the other partner will get that liability. That same concept. Same concept. I'm not connecting anything to partnership. We don't have partnership here, but still, the joint operation, joint control, we can say that concepts are more or less connected to partnership. So we have to show it as contingent liability. Okay. The other one, question number, the case study number 7. We have only 7 case studies. So in that case study, B part. The last case study, last Neelanchal has entered into a 10-year contract with Uttaranchal refineries. Okay. Neelanchal, Seemanchal, Uttaranchal. So Neelanchal has entered into a 10-year contract with Uttaranchal Refineries Private Limited, hereinafter referred to as Uttaranchal, for purchase of natural gas. Neelanchal has paid an advance equivalent to total quantity of gas contracted for 10 years. Oh my God. Based on the contracted price, 10 years gas payment you have already made. So it's like an advance given, right? Advance given to supplier. Yes. This advanced amount carries interest at the rate of 12.5% per annum, which is settled by Uttaranchal by way of supply of extra gas. Did you understand that? I paid you, I have given you an advance. I've given you an advance and one second. Okay. I have given you an advance and that advance for 10 years I have given the advance. So 12.5% is the interest that supplier should give me. But instead of supplier giving me an advance interest, they will supply me extra gas. The contract requires fixed quantities of gas to be supplied each month. Additionally, there is a price adjustment mechanism in the contract whereby the difference between forecasted price of gas and prevailing market price is settled in cash on a quarterly basis. If Uttaranchal does not deliver the gas as agreed, Neelanchal has the right to claim compensation computed at the current market price of the gas. Neelanchal wants to account for the contract in accordance with 109 and seeks your input in this regard. Come on, listen. Can you account this advance given as per Ind AS 109? Now, what is given? So, I have given an advance payment. Okay, so there is a contract. And are you getting cash in return or are you getting a non-financial asset in return? You are getting a non-financial asset in return. If a contract is entered into to buy or sell a non-financial asset, is it covered as per Ind AS 109? On use exemption. No, this is out of the scope of Ind AS 109. But if gas is not settled, if the delivery of the gas has not happened, then you can get the current market price of that you can get the compensation in cash. If there are market fluctuations also, you can get that cash difference. Interest also you are getting in the form of supply of extra gas. So what is to be done? In days 109. Here maybe if you get this for 5 marks, what should I write? Exam what should I write for exam? Here you need to write about that provision with regard to own use exemption. Here from this you should write both the provisions. Both the provisions means if the contract is entered into to buy or sell a non-financial asset or non-financial item. If net settled, it is within the scope of Ind AS 109. Then gross settled. This provisions you need to write. Gross settled by delivery. That is for own use. Gross settled. Then not as executory contracts. Not covered as per Ind AS 109. It is executory. Nobody has executed. Wait for the execution. So the whole our ICA has written a long sentences about all this provision. I'm explaining the content. So listen, let me read this. Contract with Uttaranchal. See all these provisions they have written. So in the given case, contract with Uttaranchal refineries will result in physical delivery. By reading the content, the chances of collecting cash is rare. There will be physical delivery. Physical delivery, that is commodity and not cash. Accordingly, it appears that this contract would be an on-use contract falling outside the scope of Ind AS 109. Are you all following? Those who are there, are you all following this? Therefore, it would be treated as an executory contract. However, there can be arguments. No, but there will be cash. Or if there is an argument, that is what? Diplomatic answer. However, arguments could be placed that the contract is net settled due to penalty mechanism. Okay, further, if natural gas is readily convertible into cash, the contract would be net settled. If net settled, if there is volume flexibility, then it is regarded as a return option, which falls in the scope of 109. However, what is this with Manslayer? Did you understand this? Additionally, if there is a volume flexibility, the contract would be regarded as a return option. Option where you are the writer. Okay, which falls within the scope of 109. If you can prove that this is net settled. If you can prove that it is net settled, then it will fall within the scope of 109. However, now my conclusion. What is the conclusion? The contract will probably continue to be regarded as, but in this case, for next 10 years contract we have entered into for gas supply. If gas is not supplied, if market price falls, then only there will be issue. So this is for on use and continues to be expected like that. Therefore, on use designation which it cannot be considered as financial asset or financial liability. It is out from the scope of 109. Did you get an idea about this question? So basically what I feel is when we read this, we will not get an idea about what they are telling, what they are intending. So we need to read carefully and write that content. I'm discussing only the content here. Okay, so there are 7 case studies. Of case study number 1, case study number 2 already came for exam. But this 3 inventory case, 4 that impairment goodwill, 5 that Deepak Limited full question Iktara, 6 and 7 they have not tested, can come for exam. Okay, so I'm just giving you some idea about what these questions are. Okay. Okay. Now, and we have 6 TYK also. Of that, question number 1, I'm not going to do question number 1 because question number 1 is something which we have already done in class. PP, investment property. The same question has been asked twice. This came in May 2018 for 10 marks and the same question came in July 21 for 8 marks. Okay, so this is something property 1, 2, 3. So there are so many mistakes you need to correct kind of question. Can I skip this or anyone feels like no, let's read, let's do this property 1, 2, 3. 3 is a let out property. So it is investment property. Can you do revaluation model? No. For property 1 and 2 are same properties. One is cost model, one is this revaluation model. Is it correct? No. And in the information they have done, they have not depreciated. Mistake. They have then they revalued and gain is transferred to P&L. Mistake. So you need to identify the mistakes. For that, this standard is basically out from this Ind AS 16 and 40. Okay, I think that is okay. You're not saying anything. Question number 1, I am safely skipping. Okay. Okay, yeah. Question number 2. On 1st January 2002 or 12, Sun Limited was notified that a customer was taking Legal action against the company in respect of a financial loss incurred by customer. 1st January 2012. Sun Limited was notified that maybe Sun Limited would have got a notice saying a customer is taking legal action against the company in respect of financial losses. Explain. Question 1, yeah, that's what I said. Question 1, they categorized all the three assets as PP, but one is investment property. So just 16 and 40, some mistakes. There are no tricky areas actually there. All straightforward, but they have done mistakes. So we need to correct. That's it. So here on 1st January, Sun Limited was notified that a customer was taking legal action. Okay, I read this multiple times. Customer alleged that the financial losses were caused due to supply of faulty products. Supply of faulty products on 30th September 11 by the company. Sun Limited defended the case but considered based on the progress of the case up to 31st March 2012. We got the notice on 1st January. Now it is 31st March. There is 75% probability that we have to pay the damages. So if there is 75 probability, 37 in days 37, very good. So you need to create. If there is 75% probability, we need to create provision. We need to create provision. How much provision? 10 lakhs into 75% should be recorded. 7,50,000. No. 75% probability means 7,50,000 will be recognized as provision and balance 2,50,000 will show it as contingent liability. Okay. Now, okay, that should be the treatment on 31st March 2012. However, the accountant of Sun Limited has not recorded this transaction in the financial statement as case is not yet finalized. Always accountants are doing wrong treatments and we have to correct it. So, accountant has not recorded it. So, that is wrong, error. Accountant has not recorded it. Now, the case was ultimately settled against the company resulting in a damage of 12 lakhs on 15th May. Finally, we have to pay 12 lakhs on 15th May. The financials have been authorized by Board of Directors on 18th May. So what should be the accounting treatment? Exactly, adjusting event. On 31st March, you need to identify this as, because conditions were existing, but the accountant has not accounted it. Accountant has not done, it is an error. So this is rectify it. So recognize entire 12 lakhs as contingent. It's not contingent liability. Recognize liability for entire 12 lakhs. So P and L to provision, create 12 lakhs. Already if you have recorded 7.5 lakhs, balance you would have recorded. So now you recorded entire 12 lakhs and when you in May you will pass liability to bank, journal entry. Okay. Okay. In days 37. An easy question actually. But because I said I'll cover all the questions of analysis. That's why I did this. Is there a doubt? You're not replying. Am I stuck? Guys, am I stuck? Am I visible, audible? Clear. Okay. We will type alongside with the notes. Okay. So, have you all heard what I was saying? We need to create provision for 12 lakhs. That you all heard, right? Yes. Yeah, that's what. Okay. And in the question and answer, some of you has already posted were this question from the study material only, analysis chapter. From the study material, case studies. Okay. Now, question number 3. Actually, this question, April 2000, so not April, May 2019, we got a similar question in exam. What is this? Mercury Limited is an entity engaged in plantation and farming on a large scale, diversified across India. Okay. On 1st April, the company has received a government grant of 10 lakhs subject to a condition that it will continue to engage in plantation of eucalyptus tree for 5 years. So this is Ind AS 41, agriculture. You have a eucalyptus tree which is not considered as a part of bearer plant. You are into that cultivation of plantation farming of this eucalyptus tree. You got a grant of 10 lakhs, provided you should do the cultivation for next 5 years. Management has reasonable assurance that the entity will comply with the conditions for next 5 years, and it recognized 2 lakhs grant in statement of P&L as per Ind AS 20. Whether this is correct? Give me quickly an answer. Is that correct? No. If you are getting grant for agriculture, it should be accounted as per Ind AS 41. As per Ind AS 41, you are dividing it as conditional grant, unconditional grant. Here it is conditional grant. Conditional grant can be recognized as income only when all conditions are satisfied. All reasonable assurance are there, is not there. It is there only in Ind AS 20. Okay, Divya. Reasonable assurance case is not there. Here, only when all conditions are satisfied, as per Ind AS 41, when all conditions are satisfied. And there is one more point. If there is proportionate refund, if the grant is proportionately refundable, if 5 years, the rule is you should do the cultivation for, no information is given here with regard to that. But if 5 years cultivation is not done, only proportionate, 3 years you have done, 2 years you have not done, 2 by 5 only to be refunded, not given. So revenue can be recognized, grant can be recognized as income only when all the conditions are satisfied. So here the treatment is, you should write the treatment done by the company is wrong. Are you okay? Is this clear? If it was a bearer plant, then accounting is to be done as per Ind AS 20. If proportionately refundable also, this is correct. But otherwise, it is not correct. That information is not given. Therefore, you should wait for all conditions to be satisfied. Then, 4. Up to 4, it is small. 5 and 6 is very big questions and very important. Mercury Limited has sold goods to Mars. Mercury sold goods to Mars at a consideration of 10 lakhs. The receipt of receivables in 3 equal installments, 3 lakh 33, 333, over a 2-year period. Okay. So, one company sold to another company for a consideration of 10 lakhs and the payment in 3 equal installments over 3-year period. There is a chance for, this is which standard? Sale, consideration, so sale of goods, Ind AS 115. There is a chance for significant financing component. There is a chance for significant financing component as per Ind AS 115. The company is offering a discount of 5% if payment is made at full at the time of sale. Okay, which means if you make an upfront payment, you need to make a payment of only 9,50,000. Yes or no? So cash price is 9,50,000. But because you are paying over 2-year period, you need to pay 10 lakhs. Which means how much is the interest? 50,000 is the interest. The implicit interest rate, IRR is, so if IRR is given, IBR is given, which one will you take? As per Ind AS 115, IBR is given and IRR, incremental borrowing rate is given and implicit interest rate is given. Which one you should take? If IRR is given and IBR is given, Ind AS 115 is saying take IBR, not IRR. But if IBR is not available, then we go for IRR. And just opposite in case of Ind AS 116. 116 leases. First you should go for IRR. If IRR is not there, If IRR is not readily determinable, then we go for IBR. Are you okay? Hmm? I hope it is okay. Now, total consideration to be received is 10 lakhs. How it will be recognized? Past journal entries. What are the journal entries here? So, journal entries, first bank account debit 3 lakh 33 333. Receivables, trade receivable debit to sales. How much you will recognize as sales? How much you will recognize as sales? 9,50,000. Did you get this? Okay. Bank account debit 3,33,333. Trade receivable 6,16,667 and to sales 9,50,000. Okay. Now you know the next entry, right? What is the next entry? Trade receivables to interest. How much trade? How much? 6,16,667 into 5.36%, 333,053. Then bank account debit to trade receivables. You can combine this two journal entry. 3,33,333. 333. And last year, bank account debit 3,33,333 to trade receivables to interest. If I do the combined entry. Okay. If you have done in days 115, if you have done financial instruments, this is not a big deal. This is not a complicated one. Hmm? Okay. Is there a doubt? You want to see the answer? Is it like, see, this one? Bank account debit, trade receivables to sales. Combined entry, cash 3,33,333, interest income to trade receivables. Last year also cash 3,33,333, trade receivables, book value, balance. Okay. Okay, like it's clear, I hope. And if they show the extract, if they ask you the extract, this is previous year and this is current year. I don't know, they have given the other way. Sale of goods, interest. Next year only interest. Financial asset, trade receivables. Now, so question number 5 and 6 is not 5 and 6. Yeah, 5 and 6 is very, very, very important. No, here for interest, IRR is taken. IBR is not given. If IBR, what I was asking is if IBR was given, I'll take only IBR. Okay. If IBR was given, I would have taken only IBR. But IBR is not given in this question. Only IRR is given. So we have gone for IRR. Okay. So this question number 5 is very important. So a big question also. Question number 5. So do you need a break? It's okay, right? We can move on. Then only we'll be able to finish. Or do I give you a 5 minutes break? No break. Oh, yes. Master Creator. Move on. That's it. That's the spirit. Master Creator Private Limited, a subsidiary of listed company, is an Indian company to whom Ind AS are applicable. Of course. Okay, listed company, Ind AS is applicable. Following draft balance sheet, more or less like our Iktara Limited problem, Deepak Limited, Iktara Limited problem. But very important that you should practice this. Property, plant and equipment, 85 lakh 37,500. Financial assets, other financial assets, security deposit, other non-current asset, capital advance. This is correct, not a financial asset. Here financial asset disclosure is done. There is deferred tax asset, okay. Trade receivables, inventories, financial asset investments, other financial assets, cash and cash equivalents, okay. Now equity, share capital, other equity, deferred tax liability, borrowings. Under non-current liability, they have shown other equity, which is wrong. Then Financial liabilities, other financial liabilities, trade payables, current tax liability. Okay, there is deferred tax liability, borrowings, long-term provisions, fine. Now listen carefully. On 1st April 2011, 8% convertible loan with nominal value of 64 lakhs was issued by the entity. It is redeemable on 31st March 2015, also at par. Alternatively, it may be converted into equity shares on the basis of 100 new shares for each 200 worth of loan. An equivalent loan without conversion option would have carried at 10% interest. Interest 5,12,000 have already been paid and included in the finance cost. So what is happening here? A convertible loan, borrowing. See, here it is. If you want to try this question, first you should be very thorough with financial instrument provision. They have shown the liability as 64 lakhs and they have recorded the interest expense 5,12,000. So is that correct? Of course not. So what are you supposed to do? What here, this is separately, this is a financial instrument question. Yes or no? This is a financial instrument question which we are doing. So what we should do is we need to do the corrections. On 1st April 2011 itself, I'm not doing the calculation. Is it required? 5,12,000 into, if I need to do the calculation, 0.91 plus 0.83 plus 0.75 plus 0.68. 3.17. From where did you get this 5,12,000? 8% on 64 lakhs. Okay. Now, the 64 lakhs into 0.68. So, 5,12,000 into 3.17 equals M plus, and 64 lakhs into 0.68 equals M plus. So 59 lakh 75,040 is the liability and 4 lakh 24 960 is the equity. 4 lakh 24 960 will be the equity component and balance will be liability component. But this is on which date? Guys, are you all following? This is on which date? Sorry. This is on which date? 1st April. So year end, will your liability or equity will change? Your equity will not change. Equity will remain as the same. But liability balance, can anyone say what will be the liability balance? 59 lakh 75,040. We will unwind it 10% and repay 5,12,000. So liability balance will be 60 lakh 60 544. Very good. 60 lakh 60 544. In the balance sheet, let me show you. In the balance sheet, you need to present, balance sheet of master creator. Financial liability. This is the figure you told me, right? 6 lakh 60 544. This is the correction you need to do. And in the balance sheet, same calculations are given. So other equity is 4 lakh 24 960. So this is my first adjustment. So which means to do the first adjustment, I need to be very clear with the financial instruments. That's it. And we are all very strong in financial instruments, I hope. After the reporting period, the board of directors have recommended a dividend of 50,000. However, the same has not been accounted by the company in its financials. Correct. No adjustment. No adjustment. Okay. Yes. 3. Other current financial liabilities consisted the following. Wages payable. Other current financial liabilities. Here Other current financial liabilities in the balance sheet. Other current financial liabilities includes wages payable, salary payable, TDS payable, interest accrued on trade payables. Is there anything to be changed? This can be an MCQ question. One of these items is not a financial liability. Which one? Wages payable, TDS, because it is statutory liability. None of the all statutory liabilities are not financial liabilities. Okay. Okay, alle. Is it okay? Yeah. PPE consists the following items. PPE consists the following items. Building, 37 lakh 50,250. Land. But what is given? Land held for capital appreciation. So is it for it should be disclosed separately as investment property. Vehicles, these are used as conveyance for employees. In day 16, in day 16 PPE, this is in days 40. Factory premises. The construction was started on 31st March. Factory is also in day 16. The construction was started on 31st March and consequently no depreciation has been charged on it. The construction activities will continue to happen and it will take 2 years to complete and be available for use. So as per the standard or as per schedule 3, this should be shown as capital work in progress and not PP. It should not be disclosed as PP. So it should be disclosed as capital work in progress. So I need to show it separately. Okay. So let me take the total. Here PP is 85, 37, 500. So 37 lakh 50, 250 plus 12 lakh 37, 500. PP in the balance sheet 49 lakh 87, 750. Investment property is 15 lakh 48, 150. Capital work in progress 150 plus 20 lakh 1600. So this is the total. Okay. Okay. Yes. See, there are 12 adjustments and we are done with 4. But all these are, I think, manageable. The composition of other current financial asset is as follows. Other current financial asset. Interest accrued on bank deposit. Okay. Prepaid expense, royalty receivable from dealers. Is there anything? Royalty receivable from dealers? Only thing is prepaid expense. Is not a financial asset. This is other current asset. There is no contractual liability, contractual right to receive cash. That 3 points are not satisfied in this case. So it should be recorded as other current assets and not financial asset. Okay, I think we can move on from that. Current investments consist of securities held for trading and carried at FVTPL. Investments were purchased at 55,000 and accordingly shown at cost. The fair value is 60,000. So same adjustment which we have seen in Deepak Iktara question. There is a 5,000 gain which they have to record. Only that much. Yeah. Trade payables and trade receivables are due within 12 months. You can give a disclosure. That's all. There is no change in share capital. Easy. Nothing. Entity has intention to set off deferred tax asset against deferred tax liability as they relate to income tax levied by the same taxation authority, and entity has legal enforceable right to set off. What have you studied in Ind AS 12 with regard to set off? See, Gopinath, you asked me to do the deferred tax summary, right? That I'll give you as a video. I'll upload in YouTube, a 2-hour video, which you can adjust speed and watch. In 1 hour, it will get over. I'll upload for sure. Now, what am I saying? Deferred tax. When can you set off deferred tax asset and deferred tax liability? Deferred tax asset and liability you can set off when there is legally enforceable right to set off, and this tax can be settled on net basis within the same tax jurisdiction. They are telling both satisfied, so you can set off. So here, how much was the deferred tax asset appearing in the balance sheet? 2,54,150. Deferred tax liability 4,74,850. So there can be some adjustments, right? Yeah, there is a gain unrecorded. There can be some adjustments. We need to do that. Other equity consists of retained earnings only. Opening balance of retained earnings. So in other equity, retained earnings will come. Plus, now that financial liabilities equity portion also will come in other equity. Yes or no? No dividend is paid during the year. Assume deferred tax impact, if any, on account of above adjustment is correctly calculated. Aha. So do you need to do deferred tax adjustments? It's all correctly done. You need just do the adjustments. That's set off. Being finance and accounts manager, you are the finance and accounts manager, and I always tell you in class only all these are easy. In real life, what you're doing here only you're going to apply practically. Being finance and accounts manager, you are required to identify the errors and misstatements and prepare corrected balance sheet. No need to prepare notes to accounts, provide necessary explanations and workings. Great. So I'm telling this question has not yet tested for exam. So I'm not writing. Let's quickly discuss. First, PPE. You're all clear, right? This calculation we have actually done. We are all clear. 1 PPE we divide into 3. Yes. No change. Here security deposit, no change. No adjustment. Capital advance, no change. Inventories, no change. Now, investments, yeah, a 5,000 increase. I remember. So, 5,000 should be taken to statement of P&L, but there is no P&L statement to be prepared. So, this 5,000 should be taken to statement of P&L. Trade receivables. I hope there is no change in trade receivables. No change. Other financial assets. Here, prepaid expense has been moved from financial assets to other current assets. Okay, clear. Now, equity share capital has not changed. But other equity, what is there in my other equity? Other equity already this was given. This is opening balance given. This is opening balance given. Question already they have given the opening balance. Then current year what was appearing in the balance sheet is 25 lakh 150. Is it correct? Yeah. Maybe you feel more convinced after checking the question. See, this is what given. Total year and accumulated. Total retained earnings is this much. Okay. Of which the question says opening is, where is it? Question has given the opening 21,25,975. Now, what are the adjustments? So, please have a look. It's all easy. So, what we should do is opening 21,25,975. Then, this is the current year given. Plus 5,000 is clear, right? 5,000 is clear. Yes, 5,000 is clear. Now, what could be this 85,504? Anyone coming up and saying, ah, I got this, that is the amount. Is anyone saying? And nothing else. Then they have deducted the opening. That's his current year. Not equity. But you're close to that. You're close to that. Not equity. Equity I have to show financial instrument adjustment only. But what financial instrument adjustment? This was my difference in interest. This was my liability. So interest is 5,97,504. But interest they have already recognized as 5,12,000. So it is 5,97,504 minus 5,12,000, 85,504. More interest. That's it. So there are only two adjustments in other equity, two adjustments in retained earnings. Then you are also showing equity component, financial instrument equity component. That is how 28 lakh 44,606. So what I will say is, in the question they have given 25 lakh 150. 25 lakh 150 plus 5,000 minus 85,504 plus 4 lakh 24,960 is the equity. Other equity. Are you okay? Yes. 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 Very good. So asset part we'll say this bifurcation, then this, and this prepaid expense part, that is the only change. So here we have one change. Then convertible loan we have changed. Long-term provisions, no change, no change, no change. Deferred tax liability, set off. Deferred tax asset and liability we just set off. DTA, DTL, otherwise no change. DTL, set off DTA, then net balance. Trade payables, other financial liabilities, and TDS we have shown separately. Are you okay? There are only few changes, but see, let me tell you, you will feel okay, comfortable, I can do it. But take this question. It is there in your study material. Or those who have my book, I have added this question. Just take that question and do the rough calculations and see whether your balance sheet is tallying. Okay, you should literally try it out. Practice it by setting 15-20 minutes. You should try, because I'm not saying why only 15 minutes. That is, we are just roughly calculating it. Okay, for rough calculations, 15-20 minutes and see whether your balance sheet is tallying, which you need to practice. So we are coming to the end of this analysis of financial statements. Question number 6. Question number 6 also I'll mark as important. Maybe for a 14 marks or a 10 marks, this question is appropriate. Him Limited, having net worth of 250 crores, is required to adopt Ind AS from 1st April 2012. Okay. Rahul, a senior manager of Him Limited, has identified following issues which needs specific attention of CFO so that opening Ind AS balance sheet as on the date of transaction can be prepared. See, listen, this company is having a net worth of 250 crores, is required to adopt Ind AS. So this is from which standard? Ind AS 101. Required to adopt Ind AS 101. Rahul, a senior manager, has identified the following issues. So this is what I said, you need to do all the standards before doing analysis of financial statement. And nothing new we are learning from this chapter, only case studies, but important. So all this how to be done, that is the question. Okay, let me read this. So there are 6 issues, but all these are easy. Issue number 1. As part of PPE, company has elected to measure land at its fair value and want to use the fair value as deemed cost on the date of transaction. Carrying value of land is 5 lakhs. The land was acquired for a consideration of 5 lakhs. However, land value on the date of transaction is 8 lakhs. So, what is the rule content as per Ind AS 101? There is deemed cost exemption available for PPE. So deemed cost exemption means PPE can be taken over either at the previous gap carrying value or fair value on the date of transaction. So they wish to take over it at fair value 8 lakhs. Okay. So when you take over, what is the adjustment that comes? What is the land should be recorded at? 8 lakhs. So there is a gain of 3 lakhs. Where do you record this 3 lakhs? Normally for all the items we record the difference in retained earnings, but specifically it is revaluation gain, it can be credited to revaluation reserve in OCI. Revaluation reserve in OCI. Revaluation reserve in OCI. Okay. So take over. So what should I write? Here in exam, if you get this, you should write about deemed cost exemption, write the relevant point. So take over it at 8 lakhs and the gain should be credited to revaluation reserve in OCA. Under Ind AS, company has designated mutual funds as investments at FVTPL. The value of mutual fund as per previous gap is 4 lakhs. However, the fair value of mutual fund is 5 lakhs. See, there is no deemed cost exemption for financial assets. This should be taken over at what value? 5 lakhs. If investments in subsidiary joint ventures, deemed cost exemption is again there. Here 5 lakhs it should be taken over and the gain should be recorded in issue number 3. What should I write? No deemed cost exemption. Okay. Company had taken a loan from another entity, had taken a loan, financial liability. The loan is carrying an interest rate of 7% and it had certain other transaction cost. Oh, transaction cost is to be added or deducted in financial liability. Deducted. It was carried at cost in its initial recognition. The principal amount to be repaid in equal installments over the period of loan. Interest is also payable at the end of each year and fair value of loan on the date of transition is 1,80,000 against the carrying value of 2 lakhs. So they have given the fair value. See, financial liabilities you need to record at fair value on the date of transition. Loan amount is 2 lakhs, but fair value is 1,80,000. So I'll pass the entry loan account debit to retained earnings 20,000. Loan account debit to retained earnings 20,000. Okay. Yes or no? Is it clear? Why there is a silence? Is it okay? Yes. Okay. Issue 4. Issue 4. The company has declared a dividend of 30,000 for last financial year, not for the current year, last financial year. On the date of transition, dividend declared has already been deducted from the account and from reserves and surplus. Has declared dividend for the last financial year. Dividend is already declared and reserves and surplus is already done. Dividend is grouped under provisions. Dividend was only declared by board of directors at that time and it was not approved in the AGM. Oh, can you do that? Can I, in all the questions you have this adjustments, can I do that? It's not approved by shareholders. So no, so you will pass the entry provision to retained earnings. Reverse 30,000. So see, when you write the answer in the exam hall, when we write the answer, you should always have the feeling that I am a professional. So all professional advices is what you are doing, you are giving. So you should write accordingly. Issue number 4, give a title. Then this is the case of a proposed dividend. Proposed dividend cannot be accounted. What the company has done is wrong. So reverse. As per Ind AS, it should be reversed. As per Ind AS, it should be reversed. So provision to retain earnings. If you can write the journal entry, perfect. Then issue number 5. Company has acquired intangible assets as trademarks amounting to 2,50,000. The company assumes to have indefinite life. The fair value of intangible asset is 3 lakhs. However, company wants to carry the intangible assets at 2,50,000 only. It is intangible asset, right? Intangible asset, I can get deemed cost exemption. So I can carry over take at either 2,50,000 or 3,50,000. It's the option of the entity. If an entity wants to take over it at 2,50,000, good, no impact. No impact. And issue number 6. After consideration of possible effects as per Ind AS, deferred tax impact is computed. Deferred tax is computed as 25,000. This amount will further increase the portion of deferred tax liability. There is no requirement to carry out separate calculation of deferred tax on account of Ind AS adjustment. So what is this? Deferred tax there is no balance sheet given. So after consideration of possible effects, deferred tax is computed. This is liability. So create DTL, create 25,000. So retained earnings to DTL. Okay. Management wants to know the impact of Ind AS. Prepare Ind AS impact analysis report. Required to, earlier gap, what was the treatment? Ind AS, what is the treatment? Or also pass journal entry. Oh my God, this is very good. So let me show you the answer. So your answer should be like this. What they have done as per AS. AS 10, PPE recognized at cost. Ind AS 101 elect to measure gap or deemed cost, carrying value or fair value. So impact in, you can write the journal entry, or as a result PP will increase by 3 lakhs, corresponding effects to equity. They have not written revaluation reserve but corresponding effect to equity. That's it. So journal entry. Journal entry is written separately. Good. Fair valuation of financial assets. So earlier it will be recorded lower of cost and fair value. Now it is to be recorded at fair value. So here FVTPL, FVTOCI, different categories. So investments should be recorded with an increase of 1 lakh. That increase retained earnings. So like this you need to prepare. I need not show everything, right? Borrowings to retained earnings. Reverse dividend. Same, no impact. Retained earnings to DTL. Are you clear? So with that, this analysis chapter is done. Are you all clear? Are you okay? Is there any doubt?